today we're going to hear to talk about how to trade in bearish market conditions, which is in some respects quite relevant, kind of interesting, which we'll see. We've got plenty to discuss on that particular subject topic. If you have experience of trading in bearish market conditions, or what you found yourself works well, it'd be great to hear about your own experiences. As always, we appreciate that we have a really wide range of experience in the room joining us for our session. Maybe complete beginner, some with very experience. So if you just let us know what, if any, sort of knowledge and understanding you have of bearish markets, that would be just great and help us. And if you're watching this later on demand on YouTube, and if you find it useful and helpful, please feel free to give us a like. If you've got questions, put them in. We always love to sort of hear from you, and we're happy to engage with you and answer your questions. And if you stay with us till the end, what we'll do is we'll switch across to live markets to have a look at these particular conditions. I appreciate that. That always actually helps. So what are we going to talk about? Well, we've got to be able to define whether we are in a bull or a bear market. All right, that's the kind of page one of the sort of stuff in terms of you need to understand. We'll talk a little bit about how traders and investors adapt to these market conditions and how we, how we can view them, and we'll talk about, the best way to engage with markets that are in bearish market conditions, and we'll have a little look at some live bearish markets, right? And it's kind of an interesting one because because of what we've seen happen in markets over the last 4 to 5 months, kind of giving us some great ammunition, okay, some great sort of instant views on what we can see in terms of how markets have been performing, and understanding whether they have been in bearish market conditions, or if there are in particular already in bearish market conditions. So there's stay with us till the end, because we'll have a look at live bearish markets, as I appreciate that's always the best way, I think, to sort of try to be able to sort of just understand and embed the learning that we talk about in these particular sessions. So for those who don't know me, my name's Paul. I've traded for many years and coached many traders over the years. Primarily, I focus on trading FX indices and commodities for myself, primarily looking to sort of trade trends on the longer term, and look for mean reversion and reversal trading on shorter time frames. That's the way I particularly prefer to engage with markets. And here, Admiral Markets, okay, as you can see there, they're a Forex and CFD broker that provide, a wide range of financial instruments that you can engage with markets, with a global presence, and they are licensed and regulated across a wide range of regulatory environments, providing competitive spreads on the most popular trading products, and also providing you the opportunity to engage with markets with both MT4 and MT5 and their own Admiral Markets Supreme Edition. If you have any questions about Admiral Markets, please get in touch with your account representative, and they'll be very happy to help and guide you. But today, ladies and gentlemen, we're here to talk about how to trade in bearish market conditions, okay? As the slide says, we have seen some unexpected volatility in financial markets in 2020. That's absolutely goes without saying. Some market analysts have described the beginning of possible bearish market conditions, which we will look at and discuss now. But it does actually help to begin to understand, well, what actually are bearish market conditions? As I say, I appreciate we have a wide range of experience of people in the room. The question is, can you identify them? Do you know what it actually means? Okay, and then of course, do you know how to trade them? All right, do you engage in them yourself? All right. In this session, we'll learn how to identify bearish market conditions and how you can engage them as a means of opportunity. All right, it's quite a fascinating sort of not only sort of kind of technical challenge, but also for some people a fascinating psychological challenge. It's quite quite interesting, and we'll talk about that over the next few slides. So, it's a case of, what is a bear market, okay? And so, we've seen, like John says that, he's a beginner, he doesn't really understand. Jan has got his own particular ideas when it comes to shares, etc. So, it's about understanding what are bearish market conditions, what as it goes on, between the constant battle between bulls and bears, okay, in financial markets, what actually has to happen for us to recognize that we're in bearish market conditions. What is a bear market? Would you know how to describe it? Would you know what your view would be in terms of identifying bear markets? Well, a bear market is described to occur after a period of falling security prices, and in particular, where prices have fallen 20% or more from the recent highs. Okay, so that's the kind of, let's say, the rule of thumb that people would use. All right, okay, in particular, where prices have fallen 20% or more from the recent high. Okay, once that occurs, then it is deemed to be in a particular bear market. Okay, and that can last for weeks to years, even to decades. Okay, in some particular asset classes, and we'll have a little look at that. Okay, in a few slides' time to just try and understand it. And this can apply to all financial securities, but traders and analysts in particular take keen interest in equity indices and the US indices in particular. So it's very possible for you to have a bear market in one individual instrument, whether that be euro dollar, whether that be gold, whether it be copper, okay, whether it be Apple, whether it be the Dow, etc. Okay, it's very possible to have a bear market conditions within one particular instrument. But as a general rule, okay, analysts to describe the overall market, okay, they very often will base that on equity indices and in particular the US indices in particular. So if the US indices are deemed to be in bear market conditions, well then the markets as a whole are generally, as a rule of thumb, deemed to be sort of a kind of in a total bear market. All right, so it's just important to know that. All right, as a rule of thumb, it's where prices have fallen 20% or more from the recent high. It can go on and last for as long as it needs to, and it does apply to all financial securities. But however, what you'll find is analysts will take a broad brush means for the entire market when they see how US indices in particular are operating, and we will have a little look at that. Okay, when we switch across to once we switch across to basically we'll look at the Admiral Markets MT4 charting package. Well, then we'll be able to sort of understand that a little bit better, I hope. So Jan says, he's currently using a particular ETF, and that's absolutely, and an ETF as well can be, even though an ETF tends to be it can be a reflection of the market, it can be a bundling of a particular assets to represent a sector or a part of a market or a particular kind of niche element. That in itself, even the ETF, could be in a bear market, depending upon if, as it says there, if we've seen it fall in sort of 20% or more from the recent highs. So that's the general rule of thumb that you will find that most traders and investors would use. So here's an interesting. This is just a chart, a snapshot of the Dow Jones. Okay, so this is a weekly chart. As I said, I appreciate we get people joining us with all levels of expertise. Okay, and varying experience. As I said, this is a weekly chart. So if you're a complete beginner, complete sort of someone starting, it's a case of the got green bullish candles, red bearish candles, small fractals you might be able to see on there, a blue 20-period moving average, a red 50-period moving average, and a green 200-period moving average. And what we said as we're looking at is a case of, remember, what we'd be looking at, it is a case of understanding, when have markets been in bear conditions, okay, and when have they been in bearish market conditions? And if we're just looking at this here, okay, and let's just bring up the other drawing tool, that always kind of helps. So sort of, even though we have been in what you might have seen as a bit of an uptrend, well, we can see that we've had some significant drops here, okay, over the last couple of years, and of course, no more than what we saw earlier this year, okay. So within that, we have seen significant pullbacks, but remember, okay, it's only deemed to be in a bearish market condition if it has dropped 20% or more from its particular highs, and that's not terribly difficult to work out. It's you'll be very often see that, okay, when you're actually, if you're looking at news feeds, and even if you're not looking at, let's say, financial trading news feeds, even if you're just looking at the general newspapers, okay, just watching the news, when something like that happens, it's invariably, you'll invariably see it across most media, okay, that they'll be telling that your individual particular stock market, wherever you might be in the world, could be in a bearish market, or they're globally seen as that, okay. So as I said, it's it's that rule of thumb of like 20%, okay, then you're deemed to be in bearish market conditions. And what we saw here at the end of 2018, okay, towards the end of 2018, we actually had a drop here, quite a considerable drop there, where we dropped from around about 27,000 down to what was around about what was kind of around about sort of about 21,500. Okay, so we dropped. We dropped from 27,000 down to sort of just to just under 22,000. Okay, so we had a drop of over 5,000. Okay, we had a drop of over 5,000. It was just under that 20% limit again, but it was still a significant drop. And I remember at that time watching that, wait and see, would it actually continue? But as you can see, as has been the experience with US indices over the last few years, is what it was is actually became an opportunity to buy the dip. And we rose and rallied up until the start of this year, okay, where we were up here, kind of above 29,000, okay, 29,700, before we had an absolute collapse in through February and March, okay, where we dropped from up there above 29,000 to below 19,000, okay, into 18 odd thousand. All right, so certainly, what we had there, okay, in the Dow Jones is, we entered a bear market because we had a drop bigger, all right, bigger than 20%. So that, we saw that. We can also say that we've had, quite a strong rally off, off the back of it. And what we will do is we will have a look at the live markets in a moment to sort of see how that operates. But as I said, it actually takes quite a bit to sort of drop off of 20,000, sorry, of 20%. It actually takes quite a move, all right, and so they don't happen that often. It's more about being able to recognize and understand when it does happen, so that you are primed, okay, so that you're ready. Certainly, if you're a long-term investor, well, you want to understand when you're in bearish market conditions, because you have to recognize that if you're a long-term bullish investor, well, then the likelihood is that you're going to have a bit of a challenging time in terms of your returns if you have that kind of risk profile and engagement profile with markets. On the flip side, if you're a trader who's happy to both buy, and also to sell markets, to go short markets, well, then actually, such strong moves are actually provide an opportunity, to actually sort of short markets. I know I speak for myself is that, I like shorting markets, okay? I actually like to sell markets because, well, as you can see, even just from this sort of chart, when markets drop and when they start to drop, they can drop very, very fast, okay? And they can be volatile, but they can drop fast, okay? And that provides me with an opportunity. But I recognize that on the flip side of that, some people don't actually like that. A lot of people don't particularly like selling markets. They don't like to be short markets. Some people in particular in some of their funds and institutional ones, they're not actually even allowed to short markets, okay? They are long only funds, which means that, when things drop, by 20% or more, as I say, that can be a rather challenging and painful sort of experience. And so it's important for you to understand and just be able to, even if it is, as I said, just a quick rule of thumb, to be allowed to understand when you're actually in a bearish market environment, because of course that will actually have a difference on the way you trade and invest. That's most definitely sort of clear, and you need to understand that so you can actually engage with markets correctly. So, as we started to touch on that a little bit there already, is that it's about, what do traders need to be aware of? Okay, well, I can talk here. This is, from my own personal experience. Okay, I've traded through quite a few of these events where we've had, really big, strong falls or collapses in markets. And what I have found, and you might have actually seen that in that last chart we just looked at, is that, when markets are climbing, okay, the things happen very, very slowly, okay? Things, markets sort of, they might have been climbing, they might have actually been rising, and they might just start to top out. But what I found is that things happen very slowly, and things happen very, very quickly after that, okay? It's kind of very slow, and then things all happen very, very quickly. And as a rule of thumb, which is a little bit different in modern markets because of the intervention that we see, but as a general rule of thumb, it's still valid that markets tend to drop 3 times as fast as they climb. And that's well worth understanding, okay? And that's one of the reasons why I particularly like shorting markets, because as I said earlier, when they drop fast, okay? And that, if you're prepared, provides opportunity. And it is the old stock market adage of a bull climbs the stairs and the bear jumps out the window. It's apt. Okay, and that's very, very true. All right, a bull takes his time climbing the stairs. The stock market takes its time climbing the stairs, but then when it rolls over and falls, it's like a bear jumping out of a window. Okay, it just drops, and it drops fast. And as I said, even if you are only a long, even if you're only a buyer, even if you don't particularly like shorting, you want to be able to recognize when that's going to particularly happen, because you might want to just make a decision to close your positions and just go to being flat, okay, during a particular move like that. Along with that comment, the markets take the stairs up and the elevator down, and it is very true. Okay, and let's draw on here. It is very true, as you might have seen there on that kind of chart we looked at the Dow, is that it can literally take a long time for markets to basically to climb, and then actually it can take a long time for them to start to sort of to basically they can be very choppy there as the end, and then they can drop really quite suddenly and quite fast. And as I said, things happen very, very slowly, and then they happen very, very fast. And that's from my own personal experience. And yeah, I apologize for my artwork that I say it every week. Okay, I'm a better trader than I am an artist. Okay, but hopefully you can understand what I mean. The kind of the gist of the message that I'm trying to communicate across to you. That's that you're able to sort of to understand that, so that you're prepared, so that when you see these when you see this happen in the future, because it always will. That's just the nature of markets. Even in the sort of even in the kind of skewed sort of intervened markets that we have at the moment, there are still bear markets occur. We still have drops. We still have real collapses. Okay, and being aware of that can actually be being able to sort of identify that can help you enormously. All right, in terms of either reducing your risk if you're long, or actually being able to sort of take it as an opportunity, turn it into an opportunity for you and your particular trading and investing style. So, in terms of, what do traders need to be aware of? Well, it's important here. How can traders turn this to their advantage, right? And ultimately, that's what we want, isn't it? If you're going to be trading the market, you want to be able to understand risk, but also recognize about how you can turn that into an opportunity. Well, part of that is about being able to identify when markets are becoming tired, okay, or stretched, and we'll have a look at that, okay. We'll have a look at that in charts. It's it's easy for me to say, oh well, markets becoming tired or stretched, but it's about being able to sort of see, well, how does that replicate itself, okay, on the charts? How does that actually show through? How can you start to identify that when markets are getting ready to roll over and enter bearish market conditions? Part of it is about being quick to identify when the market is changing, and that can be very hard for some traders, okay, especially if you have a position. If you have been buying pullbacks on the way up here, as I'm drawing there, well then you're emotionally attached now, okay. You have vested interest, and in fact what will happen is you'll probably sort of have on one part you'll have optimism bias that will basically filter out anything you don't want to see, like how the fact that the market is starting to run out of energy, it's starting to slow down, it's starting to get ready to roll over, and you'll have on the flip side of it, you'll have some confirmation bias where you'll be looking for every little bit, every tick of data, every little bit of information on the media and the news to just confirm and keep confirming that market is going to particularly rise. So sometimes when you're invested, it takes a lot longer to recognize, okay, when that market is starting to slow down before it rolls over, okay, and that's something that admittedly comes with experience, and as that old adage goes, good judgment comes from experience. Unfortunately, experience tends to come from bad judgment. Okay, part of that is about recognizing and understanding and living through it a little bit. But you can help yourself by actually going through charts back for years and decades. Okay, there's plenty of data here on the MT4 and MT5 platforms that you can utilize to go through and understand and help yourself be aware of what's of how markets maneuver and behave as they begin to roll over. Is they're prepared to recognize when markets are in an official bear trend. Well, we've talked about how the kind of rule of thumb official is that when markets have dropped 20% or more. But what we'll do is we'll look at other ways that might actually help you identify that that market's in the kind of bearish market conditions. and find ways to trade new trends in bearish markets. All right, that's that's very true. What I can say is that interestingly, even this might sound very, very strange, but even in bearish markets, markets will actually probably rise more. Okay, on a daily basis, markets actually probably rise more than they fall. The problem is that when they fall, they really do fall. Okay, and that's the thing. So even though we might have a drop down, it might actually spend days and days, okay, going up and up here. Okay, just going up and up and up before it drops again. Okay, and that can be the challenge. Okay, that can be the challenge. Just because it's dropping, they don't all drop. They don't drop like what we saw in February and March here, where it's almost like falling off a cliff. Sometimes it can actually just be a fall to begin with, and then it starts to grind its way down. I mean, you can have days of actually price moving up before it falls, but when it falls, it falls stronger, and that's an element to be aware of. So this is the Nasdaq. Okay, we've got a Nasdaq here on the sort of daily chart, and we're looking at this from earlier in the year. Okay, we're looking at this from the early in the year, and those of you who've traded through it, okay, will have seen that those American indices were doing very nicely. Okay, we're doing very nicely. Okay, and this is actually from when we looked at earlier. If we looked at that Dow weekly, we looked at a period kind of 2018 to 2019, and we talked about how how markets can just roll over. Okay, how you can actually start to see elements start marking to slide away, and then when it rolls over and finally falls, it can actually move very, very quickly. So this is the daily chart of Nasdaq. Here we are through 2018, and price is actually just been moving up quite nicely. And we can see that what we saw here, what you see constantly is in this particular case, the 50 period moving average, which is the red, was acting as kind of dynamic support. Every time price came down to it, okay, we saw that price would bounce off and start to move up. Okay, we start to see that. Kind of what we started to get interested in is when actually price created this double top. Okay, those of you who've seen or joined us through various elements of the either Trading Spotlight or other Admiral webinars will know and realize that a double top is what is known as a reversal pattern. Now, just because you see one reversal pattern doesn't mean that the whole market's going to roll over and fall away. But after the market has actually been going up for a while, and actually as we see that when we're making new highs, we're not racing away to new highs. It's grinding its way up. Once we start to see like a double top here, which is what we got here, okay, in sort of over the summer and autumn of 2018, well then then we start to sort of just be aware, just be ready, just see, is this market running out of energy, it's running out of steam, it's failing to make new highs, okay, failing to make new highs, and then what we can see is that actually the price here, it started to close, okay, beneath the 50 period moving average here, something it hadn't done for for 6, 7, 8, 9 months, all right, on the Nasdaq, okay, and then so we've had a reversal pattern followed by a break of the kind of the 50 period moving average, and then price started to fall, okay, and we can see that price actually fell quite strongly down here to the 200 period moving average before price actually bounced its way up. Price bounced its way up. At which point, we'd also experienced here, this was a cross of the 20 period, moving average shorter over the quicker moving average over the 50 period moving average. Now, if you look in the Admiral Markets Trading Spotlight webinar archive, you'll find quite a few webinars dealing with moving averages in particular, in specific, there's a couple of deep dives. Just a moving average crossover, is not how should we put it? It's not some panacea, okay, or not just an absolute kind of guarantee that the market has changed direction. However, once we start to see it in confluence, where we've had a reversal pattern, then a break of the 50 period moving average, then a drop to the 200 period moving average, and we've had a move back here, which is now, remember, this has now created a lower high. So we're now starting to get an idea that, okay, there's a few things happening here that are just giving us insight that, the market's move up for the moment is over. And it's certainly not we're certainly not into an official bear market, but what we have started to see is there is a reversal, there is a rollover happening. And what we can see is that actually price makes price makes lower lows and it makes lower highs. Okay, and that is what we start to see that price action informing is that we are now moving our way down, okay, and actually moving away. And you can see here that when price rallies back up to where the sort of the 50 crosses the 200, which is very often known as death cross. Okay, once again, it's not something that I would particularly trade off. But it's a confluence of events. When you're seeing, price action giving you lower highs, lower lows, okay? When you're seeing prices rallying up and then bouncing, okay, off moving averages, and you're seeing moving averages cross to the low side, all of these are confluence events proving to us that actually, we are in bearish market conditions, and we're actually dropping our way down. And what ends this, and this is always something I find useful to sort of to think about, is that we reached a particular previous level of support here around about what would have been around about the kind of 5880 level, and then price printed a key reversal there. Okay, price prevented it, and if you don't know what a key reversal is, go and find them in the webinar archive. You'll find there's a few of them. But what we saw is price traded lower than the previous candle. But then during that day, okay, it reversed completely and it closed higher than the high of the previous candle. It was a complete psychological reversal. And we can see that price started to drift up from there. Okay, so we did actually sort of just have a really quite a significant drop there. Okay, and on the Nasdaq there in that particular level, we entered bearish market conditions. We did have a 20% drop there, and hopefully you can see that with a little bit of practice, you could see once you started to see reversal patterns, followed breaks of the moving averages, followed by collapses in price, followed by moving averages, followed by lower lows, lower highs. Okay, you've got quite a few things all coming together that give you the opportunity, okay, to recognize that uptrend is now over. Okay, and we're actually entering into a bear market for you to trade until that itself particularly ends. So, Ronald says, it also looks like an Elliott wave with 3 waves down and 2 waves up. That's absolutely right, Ronald. You clearly took good notice of the Elliott wave webinar that I did a few weeks back. That's great. It's great to know that you were listening and it's helped you. Aman says, considering where Dow, S&P, and Nasdaq are today, are you still say this is a bearish market? Well, what I would say, Aman, is just wait with me on that. Okay, we're gonna switch across to the live charts in a few slides time, and we'll have a little look and we can start to have an idea and a think about that. Okay, but this was just an opportunity to show when you start to see that confluence of events coming together, that is what gives you confidence. Okay, and that's what actually helps you recognize the kind of market conditions that we are entering. And John says, this is versatile swing trading. You are absolutely right, John. Okay, it does provide the opportunity to do versatile swing trading when you start to see nice moves like that. So, in terms of what traders need to be aware of and how traders can turn this to an advantage, well, when markets turn bearish, you're looking to either sell breakouts to new lows, okay, or sell the rallies. And I appreciate that some people, are completely new. So, when we're seeing, breaks, when we're looking to sell the rallies, what we mean by that is a little bit like what we just mentioned there, is that every time price rallies, well, these areas here, these would be opportunities for us to sell the rallies. Okay, so you're buying dips in an uptrend, you're selling the rallies, okay, in a downtrend, and that's a good way to be a versatile swing trader. Okay, once you've identified that we're entering bearish market conditions. So, once you're looking to do that, let's say sell rallies or maybe even sell, breakouts to new lows. Well, what can we use? What tools can we use to help us that? Well, what you can use is just a simple trend line. So it could be, a simple break of the trend line on the way up. That would be one of those elements that gives you that confluence of events. Equally, a trend line above the price is going down, which we'll just look at on the charts. That can help just confirm we are now staying in those kind of bearish markets. Moving averages can help. Okay, as I said, I wouldn't bet everything on moving average crossovers, but as one element of a piece that is just, as I said, just confirming with confluence events, that can be enormously useful. Same way that breaks of support, when we see breaks of support, okay, that can, all of these things that give us confirmation, okay, and confidence that the market has rolled over and is heading downwards. And also, you can have price action. We just looked at it there. Price action be used to help identify ends of trends there, okay. We saw price action, just in that previous slide, giving us a double top, okay, a reversal, all right. We then saw the price action slicing down, but then it also sort of showed us how it had sell rallies. We can start to see we were now forming lower highs and lower lows, and also equally, new announcements, right? Well, that might be news, okay. It could be either specific news for if it's a particular stock that you're looking at, or maybe it's a piece of economic news, okay, off the economic calendar, or perhaps it's an announcement by a politician or a central banker who's trying to do something to sort of stem the markets, and sometimes it actually just makes it even worse. So we will look at that in a moment ourselves. So, here's an opportunity for this is the weekly chart from Boeing. Okay, so I just wanted to show different elements, different particular instruments, different time frames to be able to understand. And some of you may have been aware of, I've been following and trading Boeing for a while, and Boeing's had a lot of problems. A lot of those problems, linked to the 737 Max, okay, airline, and we had crashes with. But then actually, what happened was that we saw that it kind of it kind of unfurled into a whole host of what were clearly quite big corporate problems at Boeing, and after Boeing had a little rally, okay, early 2019, but the news started coming out. We had gaps down, okay, price was actually sort of just coming down, right? It was just basically getting ready to roll over, okay. It hit its highs, it was rolling over, and what we were looking at were particular levels of support, in particular around about it was about 320 to 310 area. We'd also seen that yes, we had here, as I said, that the blue 20 period moving average had crossed beneath the 50, okay, but as I said, it's just one element. But what we saw was we saw kind of levels of support which we had seen they started to break. We also then saw, price rallied up, but actually the 20 period moving average acted as dynamic resistance, and you can see here price collapse, okay, and and price really did had a significant collapse there, okay. We dropped from from where we were around about $330 down to beneath $100 to $95, all right. So you can see that price drop there was actually really fast, really significant. Remember what I was saying earlier is that the markets take time to climb, but they can drop hugely. And so from from highs of early 2019 up at around about $445, we were down to $95. That's quite significant, all right. And you can see some traders might say, well, actually, Paul, do you know what, you just had a head and shoulders pattern there, which is a reversal pattern, and the neckline broke, and it broke fast, okay. And those are absolutely true. Those are all elements giving a bit of confluence, and we can see that basically price dropped. And yes, price has rallied, but as we'll look in a moment, it's really not really sort of filled anybody with any particular confidence or conviction, okay. And so really what you'd be looking to do is looking at opportunities to sell rallies. This is in bearish market conditions here, and that's what you'd be looking to work with. Here's another one on a kind of a longer version. This is Deutsche Bank, okay, and this is the monthly chart here, okay. And this is the monthly chart. It's a pretty miserable looking chart, unless you've been shorting it, unless you've been selling it, in which case it's been a great chart. So from highs up here just before before the last financial crash in 2006, 2007, we were up here around about just under 120 euros, okay. But what you can see is price really did collapse there, okay, during and after the sort of main financial crisis. Yes, it did bounce up, but hopefully you can see there that actually what we've had is just literally bearish market conditions for what you'd say is for over a decade, really, there, ladies and gentlemen. It's just continued, okay, to provide opportunities. It's just been on the downtrend, okay. We can see that the 20 period moving average is beneath the 50, which is beneath the 200. prices just every time, let's just clear this off to give you a thing. We can see that, every time prices come back up towards the 50 period moving average, okay, it's just effectively, it fell away from there. That was an opportunity to sell rallies, okay, at those particular levels. And now we've had a supporting trend line, okay, which has just, over the last, this year has broken a little bit, and we'll look at it in a moment. But hopefully you can see, that's quite clearly been in bearish market conditions, okay, and investors, okay, who have got a much longer time frame might be saying, well, Paul, I think it's great to buy at €7, 6-7 euros a share, because I think 20 years from now it might be 20 euros a share, and that's fine. Remember, investors have their own risk profile, their own time profile. Okay, as a trader, you'll be looking at, well, that has continued to be in a downtrend, okay, in bearish market conditions. For me, for that to change, I would actually probably need to see price get up and close above that 50 period moving average, which it hasn't done since back in, 2006, 14 years ago on a monthly chart. That's a long bear market, okay? That is a long bear market, ladies and gentlemen. So we'll switch across in a few moments, have a look at some live examples. But, what I want you just to remember to take away is that bearish markets provide opportunity for prepared traders. And bear markets are deemed to exist when a security has dropped 20% from its recent highs, as a rule of thumb. They can last for a matter of weeks to decades, as we've just seen there with Deutsche Bank. Bear markets can be volatile. Remember, they can actually spend more times, even if it's a bear market, they can actually have higher closes for more days than not. It's when they drop, they drop very, very quick and fast. Once you've identified them, well, then you can trade them with several different tools. Okay, you're really looking to either sell breakouts to new lows or sell rallies, which would be my own preferred way. But let's have a little check out of them on live markets to have a look for the last few moments. As always, we appreciate, here that as part of the Trading Spotlight community, it always helps to get more support and help. And you can do that by joining us on the tradersyard.com. Join us there, okay, in the Trading Spotlight group, tradersyard.com/group/312. You'll see my colleagues, Marcus and Jens, they put up some great stuff there every day. I'll be there for the rest of the day to the afternoon. If you've got questions or ideas, then please, see me in there and I'll be very happy to answer your questions. And don't forget to join us next time, okay, where my colleague Marcus, my apologies, Marcus on Wednesday will be here to discuss what is paper trading or demo trading and what are the benefits. So we'll look to cover, right, what is paper and demo trading, what are the pros and cons of demo trading, why to start with paper trading, okay? So that'll be Wednesday, 19th of August, 2 o'clock, okay, London time. Check your inbox for the webinar link, or take a look on the admiralmarkets.com website, and you'll find there are lots of analysis and education and resources on there. As always, you can contact us, email global@admiralmarkets.com. You can look at us, okay, youtube.com/admiralmarkets, where you'll be able to see this and all the rest of the Trading Spotlight webinar series, and also on facebook.com/admiralmarketsglobal. So I hope you found that useful. That's given you a little bit of insight into what we see in terms of trying to understand and recognize bearish market conditions and how we would look to engage with them. So we've got a few minutes left. Okay, so what we'll do is, if you just bear with me, we'll switch across to the live markets and we'll have a little look at what's going on there and try to identify what, if anything, might be in bearish market conditions at the moment. Super. So I'm hoping that you can all still see me, hear me. Okay, that's a good start. So here we have, this is Admiral Markets MT4 platform. I have a profile called indices, where I have the majority of the major world equity indices in one profile there, so I can very quickly get a view of what's going on in the world. And what I'm looking at here, okay, here on the top, I've got the Dow Jones, I've got the S&P 500 and the Nasdaq, all right. And then on the bottom, I have here the DAX, okay, the Nikkei, the ASX, the Australian, and the FTSE as well. So let's just have a look what's been going on here. Let's take a look and see what we can do. So let's use the Nasdaq as a good example here, okay? And I'm sure most of you have seen this. Is that, you know, what we talked about earlier was this particular move here. You can see there back at sort of 2018 into 2019, but we can see that basically once that trend line was broken there, let's just draw that in there. Once that trend line was broken in, you know, we entered back up, okay, into sort of, you know, bullish market, breaking new highs, you know, and we would just ground away up until earlier this year where we really fell off, okay. We fell, you know, very fast, very quick. But you can see for yourself, ladies and gentlemen, that, you know, the Nasdaq has been quite sensational, okay, in its recovery from there, from where we were in March at what, you know, all the sixes almost, you know, almost 6,666, you know, having sort of flown our way up here to above 11,000, okay, 11,300. That has been quite some astounding move, and that's what we can say about effectively that those US indices. Okay, remember what I was saying right at the start is that, you know, you can look at it. Bearish market conditions can exist in, you know, in an individual asset, but also what we'll see is, you know, most of the kind of institutional, the major market commentators will base their view on whether we're in bullish or bearish markets based upon what we see in those US equity indices. And hopefully you can see there that whilst we were in a bearish market, even the S&P 500, we dropped really strongly, but actually we came back, okay, we came back strongly and have re-entered bullish market conditions. So what we'd say is that based on those American markets, people would say, well, actually, you know, we are back in a bull market. We were in a bear market for a very short time before we came back into a bull market. But let's have a little look and see, well, you know, does that stand true for everything? Are there elements that haven't delivered as such? And I think one of the ones that would be interesting to look at is the FTSE here in the UK. So if we look at here, let's go out to the monthly chart, shall we? You know, this is the monthly chart, and hopefully you can see here from, you know, after those kind of lows, all right, back in 2009, okay, you know, which was, let's just take this off, I might be able to see, but, you know, we most definitely had a bear market there, okay, you know, from what was 6,700, okay, 6,700. So, you know, we had, you know, a most definite, okay, bear market there, right? So after literally, if you look at 6,700, right, 6,700, you know, we're looking at 12, 13. So you're looking at, you know, once price had drifted beneath 5,200, 5,300, we were definitely in a bear market, and we can see that price dropped there quite significantly. But then, you know, we climbed our way back up and have done so. Then, you know, we had here, okay, we had a drop before, okay, we had a drop before. This was before the UK Brexit referendum, okay, where we know we'd been highs, okay, of just above 7,000, 7,100. Okay, and we dropped all the way down to 5,400. Okay, so we just entered, you know, bearish market conditions. Okay, from a 20% drop from the high. Before actually, what we did is we put a reverse on an inverse head and shoulders here, price action, and we pushed once again to those kind of new highs. And then what we had here is price, you know, moved away up to kind of all-time highs there in 2018, around about 7,900. But you can see that price just couldn't make it. It was starting to make, okay, lower highs. You know, we've talked about this. I did a webinar on the FTSE in particular, and how FTSE responds and respects kind of big round numbers. Once 7,000 broke, all right, once 7,000 broke, we can see, bosh, we dropped. And we dropped from early at the start of the year from being around about 7,600. You know, we dropped all the way down to 4,700. We did drop down there. We went into bearish market conditions. We dropped from 20% off the highs. But, you know, we can see, oops, let's just bring it here. We did have a rally up, but invariably it hasn't followed through. Not like those American indexes, which have just gone back into bull market conditions and have actually moved their way. What we've seen here, okay, is the FTSE, after rallying, has just kind of just not really sort of demonstrating any real sort of excitement at the moment. It's actually drifting away, okay? It's just drifting way lowly. It's not really terribly, it's not terribly, you know, sort of exciting there, okay, as an opportunity. But, you know, we would say that is, you know, that is effectively just we were just affected that it's still in a bear market condition. And one other very quickly, just to end up, is you might want to have a look at the Hang Seng, okay, the sort of the Hong Kong market, which you can hopefully see, you know, having been at highs here back in 2017, 2018, what we have seen, okay, since that time is that market has dropped away, okay, and is considered to be still in bearish market conditions, okay. It still drops there, and you can look at that. It's still making, okay, lower highs and lower lows, okay, and that's, and we've had a rally up, and now we'd be looking to see, could that continue back down there based upon what we see happening in China. So, just to answer the, I think there's one last question before, just to finish ourselves off here, is that a man asked, what would be the forecast for Nasdaq? Well, I mean, that's a little bit outside the remit of this particular session, but what you've just seen there is, we were in a bear market early in this year, but we're now very much into a bull market, and I think we will continue to until we get the elections, okay, and close to the elections, and we'll get an idea of where Trump and Biden are. Then we'll have a better view on what will actually, where that will go coming forward on that. So there you go, ladies and gentlemen. As always, unfortunately, we've run out of time here. I hope that's helped you. I hope that's found that a bit useful and give you a little bit of insight. As I said, I'm going to be in the Traders Yard this afternoon. I wish you the best of success with all your own trading this week, and I'll be back next Monday. And I look forward to seeing you then. Trade well, ladies and gentlemen. Cheers.